Imagine this for a moment. You are 73 years old. You did everything right. You worked for 40 years. You skipped vacations. You packed your lunch. You put money into your 401k every single paycheck. You saved. And now, in your mailbox, there is a letter from the IRS. It says you owe a 25% penalty. 25%. On money you already earned. Money you already paid taxes to put away. Your hands start to shake. Your stomach drops. You read the letter again, and you ask yourself the same question over and over. How is this possible? I saved. I did the right thing. Why am I being punished? If that scenario made your heart skip, please stay with me. Because today I am going to show you exactly how this happens. And more importantly, I am going to show you how to stop it from happening to you. I am Masha. I am a senior policy analyst. And for years I have helped retirees just like you understand the rules that the IRS, Social Security, and Medicare never explain in plain English. Today, on TaxWise Seniors, I am going to walk you through 4 quiet rules that can drain tens of thousands of dollars from your retirement. Rules that punish you for saving too much. Rules most retirees never hear about until it is too late. And please, stay with me until the very end. Because there is one small mistake almost every retiree makes in the year they turn 73. A mistake that can trigger 2 tax bombs at once. I will tell you what it is and exactly how to avoid it. Let me first tell you about Robert. Robert is 73 years old. He retired at 66. He had a long career as a high school principal. His wife, Linda, taught 3rd grade for 30 years. Together, they did everything right. They saved over $900,000 in Robert's traditional IRA. They paid off their home. They lived simply. When Robert turned 72, he heard about required minimum distributions, but he was confused about the timing. Someone at his church told him he could wait until April to take it. So Robert waited. He thought he was being smart. What Robert did not understand is this. The IRS only lets you delay your very first RMD until April 1st of the following year. Every RMD after that must come out by December 31st. So when Robert finally took action, he had to pull out 2 RMDs in the same calendar year. About $68,000 in total. That extra income did 3 things to Robert and Linda all at once. First, it pushed 85% of their Social Security benefits into taxable territory. Second, it bumped them into the 24% federal tax bracket. And third, 2 years later, it crossed the Medicare IRMAA threshold and added almost $1,100 per person to their Medicare premiums. One small misunderstanding, one missed deadline, and Robert and Linda lost over $9,000 that year. Robert called me, his voice trembling. He said, "Masha, I saved my whole life. Why does it feel like the IRS is punishing me for being responsible?" I want you to listen carefully because the answer is the same for every retiree watching this video. The IRS is not personally targeting you, but there are 4 rules built into the tax code that quietly tax retirement savings. And the math hurts. Let me break down all 4 in plain language. Rule number 1. Required minimum distributions. Under the Secure 2.0 Act, signed into law in December 2022, the IRS forces you to start pulling money out of your tax-deferred accounts at age 73 if you were born between 1951 and 1959. If you were born in 1960 or later, you must start at age 75. This applies to traditional IRAs, 401ks, 403bs, 457b plans, SEP IRAs, and simple IRAs. Roth IRAs are exempt during your lifetime. And starting in 2024, designated Roth 401ks are also exempt. The amount you must withdraw is calculated by dividing your December 31st balance by a number from the IRS Uniform Lifetime Table. At age 73, that number is 26.5. At age 80, it drops to 20.2. The older you get, the bigger the forced withdrawal. Rule number 2. The missed RMD penalty. If you fail to take your full RMD, the IRS charges a 25% excise tax on the shortfall. If your RMD was $20,000 and you missed it, that is a $5,000 penalty, on top of the regular income tax. The good news: Secure 2.0 reduced this from 50% down to 25%. And if you correct the mistake within 2 years using Form 5329, the penalty drops to 10%. Rule number 3. Social Security benefit taxation. This one shocks almost every retiree I speak with. Up to 50% of your Social Security check becomes taxable when your combined income passes $25,000 for a single filer, or $32,000 for a couple filing jointly. Up to 85% becomes taxable above $34,000 single, or $44,000 joint. Now hear this carefully. These thresholds were set in 1983 and 1993. They have never been adjusted for inflation. Not once. So a retiree with very modest income today will hit them. It is almost impossible to avoid. Rule number 4. Medicare IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount. It is an extra premium added to your Medicare Part B and Part D when your income goes above certain thresholds. For 2026, the standard Part B premium is $202.90 per month. But if your modified adjusted gross income from 2024 was over $109,000 for a single filer, or $218,000 for a couple, you pay more, sometimes a lot more. The first tier adds about $74.50 per month. The top tier adds $447 per month per person. And here is the cruel part. IRMAA is a cliff. If your income is $108,999, you pay nothing extra. If you go just $2 over to $109,001, you pay the entire surcharge for the whole year. $2 over the line can cost you over $1,000. So when you add it all up, the forced RMDs, the missed-RMD penalty, the Social Security taxation, the IRMAA cliff, a retiree with $1 million in a traditional IRA can quietly lose between $50,000 and $150,000 over a 20-year retirement. That is according to AARP's own retirement planning research. That is the math. That is what the title of this video means. The IRS does not punish you on purpose, but the structure of these 4 rules quietly taxes the retiree who saved too much. Now let me give you 3 exact steps to protect yourself. Step 1. Calendar your RMD deadlines and never delay your first one without a written plan. Mark December 31st on your calendar every single year starting the year you turn 73. If you are tempted to use the April 1st grace period for your first RMD, sit down with a tax preparer first. In most cases, taking the first RMD in the same calendar year you turn 73 is the safer choice. It avoids the double RMD trap that hit Robert. If you have already missed an RMD, do not panic. File IRS Form 5329 right away. Explain the reasonable error. Take the missed distribution immediately. The IRS routinely grants waivers when you act fast and act in good faith. Step 2. Use Qualified Charitable Distributions and SSA Form SSA 44 to lower your taxable income legally. If you are 70 and a half or older and you give to charity anyway, ask your IRA custodian about a Qualified Charitable Distribution, or QCD. You can send up to $108,000 per year directly from your IRA to a charity. That money satisfies your RMD. It does not show up in your AGI, your MAGI, or your Social Security taxation calculation. It is one of the best legal tools the IRS gives retirees. And if you recently retired, stopped working, lost a spouse, or had any major life change, file Form SSA 44. This form lets you appeal your IRMAA surcharge based on a life-changing event. Many retirees pay the higher Medicare premium for 2 full years before they realize they could have filed this form. Do not be one of them. Step 3. Get free, qualified help, and read the official publications, not internet rumors. Call IRS Tax Counseling for the Elderly at 1-800-906-9887. Call AARP Foundation Tax Aid at 1-888-227-7669. Both services are free. Read IRS Publication 554, the Tax Guide for Seniors. Read Publication 590B for IRA distributions. Read Publication 915 for Social Security taxation. These are the only documents the IRS will defend in writing. If you receive a penalty notice and you believe it is wrong, contact the Taxpayer Advocate Service at taxpayeradvocate.irs.gov. They are an independent voice inside the IRS, and they exist specifically to help taxpayers who are being treated unfairly. For Medicare IRMAA disputes, you have 60 days from the date on your determination notice to file a reconsideration with the Social Security Administration. 60 days. Do not let that clock run out. Now, before I close, please listen carefully. Do not rely on YouTube notifications to remind you about your retirement deadlines. YouTube is not your tax advisor. YouTube is not the IRS. The IRS will not send you a friendly reminder before December 31st. You must build your own system, a paper calendar on the wall, a folder for every IRS letter, a relationship with a tax preparer, or a free TCE volunteer. These are the things that protect your money. If this video helped you understand even one rule that you did not understand before, please subscribe to TaxWise Seniors and ring the bell so the next video reaches you. Share this video with one person you love, a spouse, a neighbor, a grown child who is helping their parents. Because the retiree who knows the math is the retiree who keeps the money. You work too hard for too many decades to lose your savings to a rule no one ever explained to you. I am Masha. Stay informed, stay protected, and I will see you in the next video on TaxWise Seniors.